Hey everyone, this is Marshall aka the ThetaTrada, and welcome back to another video. In this one we're going to talk about the options Greeks and why you should care about them. There's four main Greeks that are associated with each option. So we're going to go over each one, and then how we have a little example about how the options premium is calculated based on each of the Greeks changing and things like that. We'll also talk about implied volatility and what that really means when we're talking about options as well. This presentation will be linked down below, exactly like the last one. If you haven't seen the last video, the What Are Options video for beginners, you should definitely check that out because a lot of those terms will be used inside of this video. So I'll probably link that down below as well. This presentation will be linked down below. Also, linked down below is my spreadsheet that I use to track all of my options trades. I will be stopping the account reviews for a while just because a lot of my strategies that I use we haven't really gone over yet, and how to execute them and what those really mean. So I'll be pausing that until we go over why I do those types of trades and how I do those types of trades and basically how I make money. So until we go over that, I'll be pausing the account reviews, but probably in the next 2 or 3 videos I'll start with the account reviews again, and we can go over those in a little bit more in depth and things like that. So with that, I think we should get into the video and talk about the options Greeks. All right, so now let's get into the options Greeks and why you should care about them. So I think the first question that most people ask are, what are the Greeks? So the Greeks are assigned to different options to describe different risk parameters that are assigned to that option. So there are four main different risk parameters that are assigned to the option in the form of the Greek letters. So there's delta, gamma, theta, and vega. There's a fifth one called rho, but it doesn't really play a huge part in the options premium at all, so we're just going to skip that one for the sake of this presentation. So what does each Greek letter mean? So we have delta, and delta is used to describe the change in premium with a $1 change in the underlying. And again, the underlying is just the stock that you're trading the option against. It can also be used to describe the percent chance of that option has of expiring in the money. So if you have a 0.3 delta, if the stock price raises by $1, the options premium is going to raise by 30 cents. And also, if you have a 0.3 delta, that can mean that at expiration, that option has a 30% chance of expiring in the money. So now we'll go over gamma. Gamma and delta kind of go hand in hand. So gamma describes the amount that the delta will change after the $1 change in the underlying. So if your gamma is, let's say, 0.5 or 0.05 and your delta is 0.3, well, once that stock price raises by $1 and your option premium raises by that 30 cents, the next dollar that option or that stock will raise will increase by 35 cents, because that will be the addition of the gamma plus the delta. So that's how those two kind of work together. Theta describes the rate of decay of the extrinsic value of the option. So again, options expire at certain dates, and the closer and closer you are to expiration, the more and more theta decay will go on with the option. So we'll go over an example of how that plays later on in this presentation. And then you have vega. Vega represents the change in premium with a 1% change in the implied volatility. So now let's go over what is implied volatility. So implied volatility represents the market sentiment of how likely the underlying's price will change. So implied volatility, if it's really high, it can be used to anticipate future swings in price because of a certain event. So this could be like earnings reports coming out, implied volatility will be super high. This could even be like political events, like with the election that we just had, implied volatility on options, super, super high. So after that event has occurred, something like the election being over and things like that, the IV will drop back to normal levels, and yeah, that's just what happens. So companies with a higher market cap, like think about Apple, Microsoft, things like that, companies that are worth billions/trillions of dollars, will have a very low IV because earnings reports and news and things like that are not likely to have a very big change in the overall stock price. But companies that have a low market cap that are worth like maybe $1 billion or anywhere between like the $1 and $50 billion mark, which sounds like a lot of money, but in the grand scheme of things is not. These will typically have higher IV because a little bit of news can send the stock price up 15% in one day. So I think with that, let's go over to Robinhood and we can actually see kind of where these options are within the options chain and things like that, and how to actually look at this. So for this, we'll look at Ford Motors because it's sitting around $10. In my example later, I quote something around $10. So if we want to trade the options and we look at this $10 call right here, if we just click on this and dig into it a little bit more, we'd have this whole section called the Greeks. Again, you can see this on the app version of Robinhood as well. So we'll see the delta is 71 cents. So that means if this share price goes from 10.51 to 11.51, this 73-cent premium will be worth 71 cents more. So this will be worth 144 or 144 instead of that. And then also once it increases to that 11.51 number, this gamma is going to kick in, and that's going to be added to this delta price. So then the delta after this share price becomes 11.51, this delta will now be 1.03. So if it goes up to 12.51 after that, it's going to be increased by over $1. So that's really, really good. If we look at this theta value here, again, this is the amount of extrinsic value that decays off every day. So we can see that our option expires, well, this specific option expires February 5th. So that's the end of next Friday. And this option will lose around 2.5 cents every day, including the weekends, just from that extrinsic value getting closer and closer and closer to the expiration date. Now, if we look at this Vega value right here, it's 0.005, so it's not going to have a crazy huge impact on the options premium, but like near earnings calls and things like that, this implied volatility may shoot up to 120%, which means that this Vega will now have a big impact on this options premium. But then after the earnings report comes out, this implied volatility will drop down to its normal levels. Let's say it's 70 again. And then this is what's called like an IV crush. So if you get into options before a major event and then the implied volatility drops, well, even if your option increased in, if it increases past this $10 strike, you may still lose money because of the implied volatility going down and it having such a huge impact on the options premium. So let's go back and let's look at just a simple example about how these Greeks will actually play into an options premium. So let's assume on day one, the stock price is sitting at $10. You purchase this option for $1. The delta is sitting at 0.3, the gamma is sitting at 0.05, and the theta is negative 0.02. So this is our first day. This is just what's going on. Now we're going to look at day two. Day two, the stock price increased from $10 to this $11. So then we can calculate the premium now. So we're going to take this $1 that we paid, and then since it increased by $1, the delta is going to kick in, and we're going to add that 0.3. So then we hit a 1.3 premium, but the theta has to kick in too, so we have to subtract the 0.02. So that's how we end up with this 128 premium now. But since the since the stock price increased by $1, this gamma is going to kick in and change the delta. So the gamma was 0.05, so since it did raise by $1, we have to add this gamma up into the delta. So now the next time it changes by $1, it will increase or decrease the premium by this 0.35, not 0.3 anymore. So now let's look at day 3. On day 3, stock plummeted. It went from $11 to $9. So we have our 1.28 here. So we have to subtract from that. It went down by $2, so we have to take this 0.35, multiply it by 2, so that's 0.7. So we're going to subtract 0.7 from that, so we get this 0.58. But also, another day passed, so we have to subtract another 0.02. And that's how we get this 0.56 premium right here. So we basically lost, close to 50% just in this stock price going down $2. Also, if we look, since the stock price went down by $2, this gamma right here, we have to multiply this by 2 and then subtract that from the delta. So the next time the stock price moves up $1 or down $1, it's going to add or subtract 0.25 from this premium instead of the 35 or the 30 that we originally started off with. I will say that this was a very oversimplified example of what actually happens between the delta, gamma, and theta. You'll see that I didn't even include Vega in here because we're going to assume in this example that there were no big events coming up, basically. But this is very, very oversimplified because this delta, gamma, theta, Vega, these will all change as quickly as the stock price will. I mean, the stock price goes up 5 cents, you'll see the delta change from 0.71 and then maybe it'll be like 0.73, so these will change just as much as the options premium will change, just as much as the share price will change. So these are not fixed values. I know in here we used extremely fixed values. We assumed that all day the delta was 0.3, all day the delta was 0.35, all day the delta was 0.25, and all 3 of the days the gamma was 0.05. But in the real world, these numbers will be changing basically every second. So we did look at an oversimplified version of this, but I just wanted to give you an idea of like how these option Greeks works according to the premium, how that all plays with the implied volatility and things like that. So that's pretty much all there is for this video. I wanted to keep it really short. The Greeks are pretty straightforward for the most part. I know the math is kind of, for some people, it might be a little bit weird, but yeah, like I said, I tried to keep it as simple as possible. I know one question some people probably have is, why even go over the math and things like that if, that's already going to be priced into the premium when I buy it and things like that, or my broker already keeps track of all that for me. Why do I need to figure out, why this really matters? So I guess to answer that question, why it really matters is that the Greeks are risk assessments. So this is really going to play in heavily into the sell side of options, which is going to be the next video that I put out. And we're really going to be taking a good look at why I sell certain options and things like that based on these Greeks and implied volatility and everything like that. So I think I really wanted to get this video out there to really get you guys more familiar with the Greeks, and because that's going to play into such a huge part in the selling side of options. And also I wanted to get it out there because my channel name is ThetaTrada, so now you know what the theta is. It's the time decay of the option. So yeah, so now you guys know what that really means. I don't think I have really anything else in the video. If you found this video helpful in any way, or you learned something new that you didn't know, or like I said, I really just want to motivate people to actually start learning this and getting their feet wet with trading options themselves. So if this video made you do that, please give it a like. Consider subscribing because I have way more videos coming out about educational and really geared towards beginners. So if you could subscribe, that would be really, really helpful for the channel. I don't think I have anything else for you guys, so I'll see you in the next one.